In business, one of the things that we say is that cash is king, and especially for small businesses or businesses just getting started, managing their cash flow properly is going to be very critical for their ultimate success. And in personal finance, it really is no different. So that's what we're going to talk about this week is cash management and how important managing your cash is going to be for your personal success. So when we talk about cash management, what we're talking about is your routine day-to-day use of liquid assets. And when we talk about liquid assets, we're touching on this concept of liquidity. And liquidity is the ability to convert an asset into cash. And what I think is really important about that statement is that last comment in the yellow box that says, with little or no loss of value. And the reason why that's so important is that I can sell anything. I can sell this computer that I'm using right now within the hour if I'm willing to drop my price low enough. And so, I always joke in class that this always makes me think about people with substance abuse problems. They'll get their hands on anything and sell it right away and don't really care how much they get for it as long as they get something. And so that doesn't necessarily mean an asset is liquid because you can turn around and sell it right away. You've got to sell it at a price that's very close to its value in order to consider that asset highly liquid. So let's give some examples of liquid assets. Obviously, cash is going to be a liquid asset if by definition we're saying a liquid asset can be easily converted into cash. Cash is already cash. Checking accounts and savings accounts, those are basically cash. Money market deposit accounts, basically cash. So those three I would group in the same category that all you have to do is write a check or make a withdrawal in order to get the cash from those accounts. Money market mutual funds, pretty close to money market deposit accounts, except they're held typically by a brokerage company. So that's going to be very liquid also. Now these last three, they're still liquid assets, but not as liquid as the first five. Certificates of deposit. I'm going to have to go to the bank and cash in my CD and maybe even pay a penalty if I'm cashing it in early. So that's not as easily converted into cash. A T-bill. I've got to sell it. It's not cash. I can't just go to the ATM and get money for my T-bill. So that's not quite as liquid, but we have a very active market for T-bills, meaning there are always people who are willing to buy a T-bill from us. So that's why we consider it liquid. And savings bonds. Again, I'm going to have to cash that savings bond in, so that's an extra transaction, but I can always do it. So let's talk about the financial services marketplace. Again, this is all in the context of cash management. So we've got all of these financial products, some that we've just talked about, checking and savings accounts, credit cards, loans, mortgages, insurance, and mutual funds. And these are brokered in the financial services marketplace. And so we've got products on the left and then the services on the right. And some of these are related. But all of these products and services are basically designed to help us manage our money, again, as we said, on that daily routine basis. So now what types of financial institutions are out there to help us? Commercial banks. So these would be the big banks that offer a variety of services. Savings and loans, they're a little bit more specialized. They came into being typically to write mortgage loans. Savings banks, focusing more on the savings aspect than the lending aspect. And then credit unions, remember those are member owned, and so typically the fees are a little bit lower, but they don't offer as many services. Non-depository financial institutions, so you can't go and open up an account or the same types of accounts as you do with depository institutions. But these are also financial institutions because they offer some of those products and services that we saw on the last screen. So mutual funds, life insurance companies, finance companies. So they're all on both sides, depository and non-depository institutions. They are all helping us manage our money on a routine basis in different ways. So types of depository financial institutions, so focusing on that list of financial institutions that was on the left-hand side, the ones where we can open an account. Commercial banks, so that was the first on the list. Those are the largest, offer a full array of financial services, and they offer non-interest paying checking accounts. So typically, and the advantage of a non-interest paying account over an interest paying account is that they would allow lower balances without fees. And then savings and loans, I talked about these, that they came into being to provide mortgage lending services, and so they typically pay higher interest. And then savings banks, focusing on the saving more than the lending. They're pretty similar to the savings and loan. Credit unions, member-owned, remember, interest rates are typically higher, and so they're pulling together these members that have a common tie. They're teachers, they're firefighters, they live and work and play is typically the terminology we hear in the same area. So these are not going to be franchises where they're all over the country. These are fairly local. So when we're thinking about managing our money, we need to know how safe is our money. Financial institutions generally are federally insured, so that means up to a certain amount, our deposits are safe. And so they are secured by the FDIC, the Federal Deposit Insurance Corporation. And so if there is some type of problem at our institution, the FDIC for banks, savings banks, and S&Ls will protect us, and the NCUA at credit unions, and so they will insure our deposits up to $250,000. So what this means, and this doesn't affect very many of us, is that we shouldn't have more than $250,000 in one bank account, because anything over that will not be protected. And so this is just kind of an outline of the different deposit insurance programs, and so it's important to understand what the coverage level is. But for all of them, it's $250,000. So really the difference here is showing you, depending on the depository institution that you're using, they may be covered by a different insuring agency. So the FDIC for most, as we saw on that first slide, and then the NCUA for credit unions. So let's stop here and come back and get into these individual accounts.